Ladies and gentlemen, good day, and welcome to Q3 FY2026 earnings conference call hosted by Gulshan Polyols Ltd. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Viral Jain from Share India Securities. Thank you, and over to you, Mr. Jain.
Thank you, and good afternoon, everyone. Congratulations on a very good set of numbers. On behalf of Share India Securities, I welcome you all to Q3 FY26 earnings conference call of Gulshan Polyols. We are pleased to have with us the management team represented by Joint Managing Director Aditi Pasari, CFO Rajiv Gupta, and Compliance Officer Preeti Singhal. We'll have the opening remarks from the management, followed by the question and answer session. Thank you, and over to you, ma'am.
Good afternoon, everyone, and thank you for joining us for the Q3 FY26 earnings conference call of Gulshan Polyols Ltd. With me today is Mr. Rajiv Gupta, our Chief Financial Officer, and our Compliance Officer, Ms. Preeti Singhal. I trust you have had the opportunity to review our financial results and investor presentation. Gulshan Polyols is a multi-product, multi-location company with operations spanning ethanol, grain-based specialty products such as sorbitol, starch and fructose, and mineral-based chemicals including calcium carbonate and various grades of calcium carbonates. We operate 9 manufacturing facilities across Madhya Pradesh, Gujarat, Uttar Pradesh, Assam, Dholakua, Abu Road, and few more on-site facilities across India. Before I begin my remarks, I am pleased to share that we have delivered earnings in line with our guidance. For Q3, our consolidated EBITDA margins were at 13.7%, and for the 9-month period, it was 9.4%, consistent with our stated guidance range of 9 to 10%. Margin expansion during the quarter was primarily driven by the softening of raw material prices, which had a positive impact. A key contributing factor was the government's mandate requiring ethanol producers to procure 40% of their rice requirements from FCI at a fixed price. This policy has softened open market prices for our key raw material, maize and broken rice, by improving overall grain availability and liquidity in the system. As a result, this improvement in input cost dynamics has translated into stronger operating leverage and enhanced profitability for the quarter. Looking ahead, we remain confident in our ability to sustain these margins with a guided range, supported by stable policy conditions and disciplined execution. Starting with the operating environment, a key policy development during ESY 25-26 has been the government's mandate requiring 40% usage of FCI rice for ethanol production. This has materially eased pressure on alternate feedstocks such as broken rice and maize, improving overall grain liquidity and enhancing the overall raw material availability in the country. As a result, the ethanol segment has been meaningful margin improvement even before factoring in state incentives. While availability has remained adequate, raw material price volatility continues to necessitate calibrated procurement and inventory planning. Additionally, as state incentives begin to flow through the P&L, we expect further improvement in bottom line performance. Domestic consumption across end-use industries remained stable during the quarter. In response, we continued with our staggered and risk management procurement strategy, reducing exposure to peak pricing cycles and improving cost visibility. From an industry standpoint, 20% ethanol blending represents the first major milestone to assess industry readiness, feedstock availability, and capacity scalability. India's ethanol program continues to deliver structural benefits by reducing crude oil imports, saving foreign exchange, and supporting farmers and rural development. Overall, the medium to long term, we see India's roadmap moving closer to global benchmarks such as Brazil in blending petroleum with ethanol. While 20% is the current milestone, Higher blending levels are achievable over time, and we positively expect this blending ratio to go up in the near future. Turning to segment performance, we delivered our strongest results to date in the ethanol business. Growth during the quarter was driven by successful capacity ramp-up at our plants in Madhya Pradesh and Assam. Ethanol continues to be the primary growth engine for the company. We currently have orders of approximately 1,200 crores, translating into about 17 crore litre for FY2025 and 26. Our total ethanol production capacity stands at 26 crore litre per annum. We expect these allocations to increase further in the upcoming tender cycles of C2, C3, C4 over this year. The grain processing segment continues to face headwinds due to industry-wide overcapacity in starch. As a result, starch prices remain under pressure. However, starch now represents a relatively small portion of our revenue mix. As highlighted earlier, we have rationalized loss-making starch volumes while maintaining profitability in sorbitol and fructose. We expect a gradual recovery as industry conditions normalize. The mineral chemical segment delivered steady performance in line with expectations, supported by steady demand, long-standing customer relationships, and consistent operational execution. This business continues to provide margin resilience and predictable cash flows. Before moving to the outlook, I would like to highlight that the company has received a total amount of 21.8 crore from MPIDC towards state incentives and industry promotion incentives related to our Madhya Pradesh operations. This receipt strengthens our cash flows and reflects continued policy-level support for ethanol and agro-processing investments. I would also like to clarify that the PLI-related incentives have been factored into our reported EBITDA margins for this quarter. Looking ahead, we remain constructively optimistic and expect to achieve full utilization of our distillery capacity in FY26 and 27. This outlook is supported by improving industry demand and a gradual normalization across end markets, which would enable higher utilization and operating leverage across segments. The mineral chemical business is expected to continue operating at steady capacity, delivering predictable cash flows and consistent margins. For FY26, we remain on track to deliver a top line of about 2,300 crores, driven entirely by optimization and high utilization of existing capacities with no incremental capex planned. EBITDA margins are expected to be in the 9 to 10% range at the consolidated level, with the ethanol segment delivering 10 to 11% operational margins. Looking ahead to FY27, we aspire to achieve 2,600 to 2,800 crore in revenue, assuming 80 to 90% utilization across all divisions. We are closely monitoring whether the 3,000 crore milestone can be achieved without additional capital expenditure, led by continued ethanol ramp-up and operational efficiencies. Overall, our strategic priorities remain firmly centered on disciplined capital allocation, operating efficiency, and long-term value creation. With that, I now hand over to Mr. Rajiv Gupta to take you through the financial performance.
Thank you, Aditi ji, and good afternoon to everybody. As already Aditi has said, that there is an marked improved performance the company has given for the quarter 3. There is a strong operational and financial performance reflecting both earning recovery and improving business mix. Revenue for the quarter stood at 626.7 crore, primarily driven by ramp-up in the ethanol segment. This growth was partially offset by continued headwinds in the grain processing segment, while our mineral chemical segment remains stable. Our EBITDA margin also increased by 211% YOY to 85.6 crore, supported by softening input prices. Importantly, this improvement came despite the underperformance in grain processing business segment of the company. EBITDA margins expanded by 920 basis points YOY, which comes to 13.7%, indicating a structurally stronger earning base as newly commissioned ethanol capacity begin to scale up. Our profit after tax grew up by 501% to 40.9 crore rupees, reflecting both improved operating performance and margin recovery. Overall, the quarter demonstrates that as input costs normalize and ethanol capacity ramp up, the business is transiting to a stronger and more sustainable earning profile, positioning it well for medium-term growth. With this, I would like to add up my address to the investors. Now, it is now open for the floor for questioning. Any question regarding the performance and it.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. First question is from the line of Pushkar Jain from Midi Capital Management. Please go ahead.
Hi, congratulations for great set of numbers. I just wanted to ask about the current maize prices and your outlook for the year. And because of the softening, do you expect that like ethanol based out of maize prices, there is a chance that government would reduce the prices in the next season? Just wanted to understand your view regarding that. Thanks.
So current maize prices are varying between 18 to 21 rupees across India. In our Madhya Pradesh plant, the current maize prices are about 18 to 19 rupees, and in Assam plant it is about 20 to 21 rupees. So regarding the government taking away the or reducing the maize ethanol prices, actually there has been a pressure from the ethanol industry on the government due to receiving lower allocation. A lot of units have, including us, have received lower allocation than what it was applied for because of overcapacity of ethanol production in the country. Hence, they're already under pressure, and in fact, a lot of units have received allocation as low as 20 to 30% of the total capacity. So, considering all of these factors, we don't think that the government will put further pressure on the ethanol industry by reducing the prices of maize ethanol.
All right. Thanks a lot, ma'am.
Thank you. Participants, you may press star and one to ask the question. Next question is from the line of Nishita from Sapphire Capital Partners. Please go ahead.
Yes. Hello.
Hello.
So as you mentioned that the grain processing segment faced headwinds in the quarter, and that's contributing 147 crores of revenue, and the margin is very less compared to the other two segments. So going forward, are we going to reduce the contribution from that segment, or how are we going to see the revenue contribution from the three segments going forward?
So I'll answer the second question first. Going forward, we are, or even this current year or the next year, we are expecting, in the current year, we're expecting a revenue contribution of about 1,400 to 1,500 crores coming from the ethanol division alone, and about 800 crores coming from the grain processing division and balance from mineral. So the revenue mix will remain consistent in this direction even for the next year. More than 60% of the revenue will be coming from the ethanol division and balance from the mineral and grain processing division. The margins have been stressed for the grain processing, especially for starch. Sorbitol is still doing all right. It is in positive EBITDA, but it is starch business which has been pulling it down. And we are working on it, how to improve the margins. We are actually working on the power and fuel costs. We have introduced an RDF boiler in our Muzaffarnagar plant, which will help us bring down the power and fuel cost and improve the operational margins. So we are trying various ways how we can work on this segment to improve the overall margins. The impact should start coming in the next 3 months. So we are hopeful that the margins will improve going forward from here.
Okay. So, in FY27, do we see the, overall consolidated margins at the same 10 to 11% range, or can we expect better margins
Consolidated margins, we are expecting in the range of 9 to 10%
for FY27 as well?
for FY27 as well. Yeah.
Okay. Okay. And the last thing would be, if you can just reiterate your guidance for FY27, was it 2,600 to 2,800 crores?
Yes, that is our target for the next year, at about 15% capacity ramp up from here.
And that will be at 90% utilization, right?
That will be at about 80-85% capacity utilization. We have scope with the current capex, current infrastructure. We have scope to go up to 3,000 crores, but that again depends on market dynamics and the tender allocation from the OMC. So, looking at the current scenario, we think 2,600 to 2,800 crores should be a reasonable guidance for FY27.
Okay. So, do we have any CapEx plans for FY27 then once we reach the max capacity utilization in the current plan? How do we see a scaling forward?
So until FY27, we are actually fully focused on improving our cash flow, giving out good results quarter on quarter, and improving the cash flows and reducing the working capital utilization. Any kind of fresh capex will come in FY28, but before that, we will be spending FY27 in our planning stage for the next set of capex, which will come in FY28.
Right. Okay. And the last question would be, what is the current capacity utilization?
So current capacity utilization in the ethanol segment and the grain processing segment is about 65 to 70%.
Okay. Okay. Understood. Thank you so much.
Thank you. Next question is from the line of Pratik Singhania from Stage One Investments. Please go ahead.
Yeah. Hi, good afternoon. My question is with respect to the macro, that with respect to the base starch product, like how do you see India trying to recapture the lost market share that in the export market that we had prior to the maize prices reaching the roof kind of a pricing?
Can you please repeat your question? It's not clear to me.
I'm saying with respect to the India's export market in the starch business, by when do you think that we can recapture the lost market share in the export market?
See, it is all a game of demand and supply and the prices, because eventually starch is a raw material for the end product. So there has been a correction in maize prices in the recent last few months. So already the exports from India for starch has picked up once again, which had totally dropped because of maize prices being unviable. So in this coming year, we think that the export of starch should pick up, and the domestic demand should ease off.
Okay, so it is not picked up as of now, because I thought like starting December it should have already picked a bit with respect to the export given the prices.
Yes, it has picked up. It has picked up.
And as compared to the last cycle, this cycle, China in the base commodity or the base starch product, it has also ramped up a lot of exports. So how do you see Chinese as a competition now? Because earlier they were quite focused towards value-added product, but as compared to earlier, like now they are also focused in the base starch products. So what's your view with respect to the increased competition from China?
So as I said, that it is all a game of demand and supply. So with the current maize levels, India is again back in the game. It is again competitive. So we are already exporting sorbitol to about 45 countries. The export has gone up in last few months because of the price competitiveness. And even starch has picked up again. Starch exports have picked up again. So when maize which is at a level of 17 to 18 rupees a kg, it becomes competitive for world exports.
Right. But you see, like large wallet of the customer getting captured, like currently serviced by a Chinese guy, which was not the case like say 3-4 years back. Any such trends which is visible?
Oh yes, definitely. In fact, that is the reason why our grain processing business has got hit, because India was losing to China in the export market, and as a result of which all the production of starch and starch derivatives was getting dumped back into the country. As a result of which the price was falling, and the process and these products are getting are running in negative.
Okay. And given your experience with the customer, like by when do you think this export revenue, which was there at the peak in last 2-3 years, that can be achieved again by the company?
So this year is looking like a good year for the maize crop. In the Rabi crop is expected to be good. I mean, the Kharif crop is expected to be good. So if the maize levels come down to 16 to 17 to 18 rupees a kg, then India becomes very, very competitive.
Okay. Thank you so much.
Thank you. Next question is from Gaurav Chela from Phillip Capital. Please go ahead.
Yeah, thank you for giving me this opportunity. My question is from a macro perspective. With India's ethanol blending roadmap evolving, how should we think about the sustainable utilization levels across the distillery's capacity?
So if you are talking about our own plants in Madhya Pradesh and Assam, both the plants have signed a long-term offtake agreement of 13 crore litre of the total capacity of 26 crore litre, out of which 13 crore is in a long-term offtake agreement which has already been signed, which is 50% of their capacity. Balance, this year we have already received allocation of 70%, which we are expecting that it will go up in the additional cycles. So for a plant to run efficiently, effectively, 60 to 70% is definitely the minimum utilization to achieve optimum conversion cost. And as these capacities go up, the conversion cost will just go down further.
Okay. I have another one from the medium-term perspective. Do you see the Gulshan evolving into a specialty ingredients plus biofuel platform rather than a commodity grain processor? And what milestones should investor track to validate these transitions?
So you see, actually, our traditional business of sorbitol, of fructose, these were all specialty chemicals, which after a few years became commodity.
Okay.
Any specialty chemical doesn't last for more than 2 to 3 years because of the competition which eventually comes up, So initially, even sorbitol and fructose were specialty chemicals. After a few years, they also became commodity. But going forward, any new capex which we are constrained to do in FY28 will be in the specialty chemical space with more value-added products and import substitutes which are not being already manufactured in India. So our focus will be to introduce a product which is not being manufactured in the country and is only being exported. It will be in the specialty chemical space.
Okay. I think your value-added starch derivatives portfolio has been expanding, right? So what proportion of incremental capex is being directed towards specialty versus commodity output?
So going forward, it is very difficult for me to give these numbers at this time without any kind of a board approval. But definitely we will be looking at a large project going forward. See, our last capex in the ethanol segment between Madhya Pradesh and Assam was about 500 crores between both the plants, which generated a revenue of close to 1,500 crores. So any new investment will be at least in this capacity or maybe more.
Okay, fine. Thank you.
Thank you. Next question is from the line of Nirav Vanasali from Systematics PMS. Please go ahead.
Hello, am I audible?
Yes.
Yeah, thanks for the opportunity. So I wanted to understand on the macro level, how do you view E20 blending milestone? Like we have almost achieved that, and like what are the policymakers thinking of increasing it? Because I heard from some other corporate in the same business that they were planning to increase it to E27. So what is the update or anything you are hearing from that front? And other one is on right now we are dealing it with the petrol. So what are the plans or where are we on the diesel front, like any from the policymaker side, how is it to understand on that front?
So say 20% blending is only the beginning. It is the first milestone which has been achieved by the government. It was actually a milestone to actually test the industry readiness, the system availability, and the overall system readiness, to start blending 20%. That has been achieved very, very smoothly in much before time. Government will definitely increase the blending in the near future. Maybe it will start by 2 to 3%, and eventually, see, their roadmap is to follow the roadmap of Brazil, which is 55% blending and making ethanol efficient engines. So, which is a gradual process. They're already in touch with the automotive industry to start introducing flexi fuel vehicles. So both these things are happening parallelly. 20% is only the first milestone. It's in the ethanol blending program, which has been achieved. In the near future, with the current engines, the government can easily blend about 24 to 25% with the current engines without causing any damage to our vehicles. Any further than that, they will need to introduce flexi fuel vehicles, which they're already in touch with the automobile industry and working on the same.
Okay. Yeah, thanks for the answer. Thanks a lot for this.
Thank you. Next question is from the line of Ankur Gulati from January Capital Markets. Please go ahead.
Can you help me with the grain mix for ethanol in this quarter?
So, 40% is the mandate of FCI rice. So, we need to use 40% FCI rice. That's a mandate given to us by the government. The balance 60% will be a mix of 45% maize and 15% rice, broken rice.
And any cost benefits of sourcing from FCI? Is there a discount to spot prices or anything like that?
No, this is a mandate which we have received. There is, in fact, we are working on very low EBITDA margins on making ethanol from FCI rice. But we enjoy the kind of grain availability which this has created in the country. So we are enjoying better margins in balance 60%.
Okay. All right. Thanks. Yeah.
Thank you. Next question is from the line of Manan Shah from Ardeco Asset Management. Please go ahead.
Hi, good afternoon. If we consider only ethanol business, what would be the percentage of byproduct, that is DDGS, in the sales mix? And does the import of DDGS from USA, shall it put a ceiling on DDGS prices in the domestic market? Can it be detrimental to margins in any case?
Yeah, so there's a very ballpark figure of whatever revenue you see which comes from the ethanol. There is additional revenue of about 25% from the byproduct. So if there's we have ethanol orders of 1,200 crores, so we get additional revenue of about 300 crores from its byproducts. So there is a ballpark calculation of 25% on top of ethanol revenue, which comes from the byproducts. Regarding allowing import of maize DDGS from US, as we see it, we only see it as a good news for the ethanol industry. Number one, because the import of maize DDGS in the country will not be less than 26 rupees a kg, and the current DDGS prices, domestic prices, about 22 to 24 rupees a kg. So and secondly, the protein content and the oil content in Indian DDGS is better than what is in the US DDGS. And when an end consumer is buying DDGS, the main factors which it is looking for is protein, and number two is oil. Both these factors are better in Indian DDGS as compared to US DDGS. Hence, we think it is a very good news because it will only and only improve the price realization of domestic maize DDGS in the country.
Okay, great.
Thank you. Next question is from the line of Arav Cheda from Blue Rock Investments. Please go ahead.
Hello.
Hello.
Can you hear me?
Yes,
Yes.
go ahead. You're audible.
So the adjusted EBITDA per liter in this quarter in ethanol was rupees 9. So is this sustainable for the future quarters?
Yes, it is very much sustainable.
Can you explain anything?
As we have been saying that there is ease off on the raw material prices and which has improved the overall margins. So we are expecting in the current quarter and coming quarters, we are expecting similar kind of EBITDA margins in the ethanol division.
Okay, thank you.
Thank you. Next follow-up question is from the line of Pushkar Jain from Meli Capital Management. Please go ahead.
Hi, ma'am. So I was just looking at one point in March 22, our grain processing division had done a EBITDA of like 81 crores. So what situations, like at what maize prices should we, again be able to do a similar kind of number? Just
You see, because of those figures in FY22, there's overcapacity which has come up in the country for starch and starch derivatives.
Right.
Any business which does well, everybody is watching that business.
Right.
And and the existing manufacturers, everyone ramped up their capacities because at one time starch business was rocking. It was giving us exceptional margins, So everyone ramped up their capacities, as a result of which there has been overcapacity in the country, and those margins are look difficult to come back in the current in the same products.
Right. But at that point also, I think maize prices were nearby. It is just that more capacities have come up.
So that is now not linked to maize price anymore. That is linked to now, that time these were specialty products which in 3 years have become commodity and they are fighting for prices because of overcapacity.
Right. But
see, every product has a life cycle, Every product has a life cycle.
Right. But as per your understanding, how things will evolve in this, how do you see our company evolving in the next year probably, or how things will shape according to you, like on the margin front for grain processing?
So, sorbitol is still doing all right. It is still generating a positive EBITDA. It is the starch business which is under pressure. We are working backwards on how we can improve the operational efficiency, internal efficiencies in the starch business, because the selling prices are not supporting. So all we have to do is, of course, ramp down the production, plus whatever we are producing, we are working on internal efficiencies. We are shifting our boiler to RDF, which will hopefully give us some cost saving in the power and fuel, and seeing how we can optimize our internal efficiencies. So we have to work on that. We are working on that in the current portfolio.
Right. Thanks a lot.
Thank you. Next question is from the line of Amit Agisha from HG Hava & Company. Please go ahead.
Thank you for the opportunity and congratulations for good set of numbers.
Thank you.
What is the current realization per liter across all ethanol plants?
So see, we are actually working on EBITDA levels. So, you can just kind of calculate. It is about 9 to 10 rupees per liter, on the current, if I just see the current EBITDA levels, it is about 9 to 10 rupees per liter.
The realization?
That is the realization at EBITDA level.
Okay. And madam, are you planning to enter into SAF, sustainable aviation fuel, or bio-based specialty chemicals, or 2G ethanol?
So see, the technology for SAF and 2G ethanol has yet not been established. It is still under R&D. And whatever projects have come up are all funded by the government. There are no private players which have yet entered it because the technology has yet not been established. So we are also waiting and watching the sector.
And is there a dedicated leadership accountability for each different segments, 3 of them?
Internal leadership?
Yes, the ethanol and the minerals and the grain processing.
Are you talking about internal management?
Yes.
So internally, there is no division of leadership across segments. But we do supervise independent plants from top to bottom between the promoters. So it is more like a vertical, supervision, which we are looking at plants. But there is no, as such, division of segments internally between the promoters. We're all looking at everything together.
We can put some color on what will the segment mix the management envisages over the next 3 to 5 years?
So see, we will be expanding in the specialty chemical business going forward in the next 3 to 4 years. So it will be, the expansion will come in the grain processing division.
And then the last question, about the debt position, and the blended cost of interest.
I'll request our CFO to answer this question. 1 minute.
Yeah. Just can you repeat the question, please?
Yeah, the net debt and the blended cost of interest.
See, presently working capital borrowing is around 7.5% from 3 banks which we have inducted for a working capital requirement. And I am talking about December now. For the last 2 months, it is being further reduced to 7.25% working capital interest ROI which we are borrowing from the banks.
And the net debt equity ratio?
Debt equity ratio is around 0.5% or 0.5%.
Thank you, and all the best for the future. Thank you.
Thank you very much.
Thank you. Next follow-up question is from the line of Manan Shah from Ardek Asset Management. Please go ahead.
Yes, thank you. I think there's a lot of good visibility on revenue and EBITDA for the ethanol segment. What a lot of questions are looking for or probing for is any green shoots or any positives in the maize division. So if you can explain the sales mix, broad sales mix of maize division between starch, sorbitol and fructose. And when we talk about specialty segment for the grain processing division, are we looking at some of the fermented products that some of the players in grain industry have started, something like sodium gluconate?
So getting out any product sale will not be possible without board approval, but we are looking at similar lines. So I can just say that broadly. And regarding the product mix, about 60% of our revenue is coming from sorbitol and its byproducts. About 30% comes from starch and 20% comes from fructose.
Okay, great. Thank you.
Thank you. Next follow-up question is from the line of Nishita from Sapphire Capital Partners. Please go ahead.
Yes. Hello. So I just had a clarification question. You mentioned that we can sustain the ethanol margins, the current ethanol margins, which are at 17%. So going forward also, like for FY27, the whole year in the ethanol segment, can we see the 17% margin in ethanol segment?
The ethanol segment, 17% includes PLI.
Okay.
The additional PLI which has been received, which has been factored in.
Okay.
So just on this call, I have mentioned that sustainable margins of 9 to 10 rupees per liter is what we are looking at, which is about I would say 12 to 13%.
Okay, understood. Thank you for the clarification. And another question was, you mentioned that we are looking for expansion in the grain processing segment. So again, if we have less margins in that segment, what is our thought process behind the expansion in that segment and not the ethanol or the mineral processing segment in which we have better margins?
No. We are not expanding the current portfolio. We will be introducing new products in the specialty chemical space. This is what we are saying.
Okay.
So they will get factored into the grain processing division. We are not looking at increasing the production capacities of our current products in the grain processing. We will be introducing new products at a suitable time.
Okay, understood. Thank you so much.
Thank you. Next follow-up question is from line of Manan Shah from Ardeko Asset Management. Please go ahead.
Hi, sorry, last question from my side. So this was regarding our Q3 numbers. So what we understand is 21.8 crores is something we received from PLI subsidies, and 5.36 crores is a reversal due to change in accounting treatment for interest subvention. So the net effect of subsidy benefits would be around 16.44 crores in our Q3 numbers?
Correct.
Broadly? Okay.
Yes.
Perfect.
Thank you. Next question is from the line of Janvi, individual investor. Please go ahead. Janvi, can I request you to unmute your line and proceed with your question? Due to no response, we move on to the next participant. Next question is from the line of Nagesh, individual investor. Please go ahead.
Good afternoon. Congratulations for a good set of numbers.
Thank you.
I just wanted to know about this 536.9 interest subvention scheme, which has been reversed. Will it be shown in the fourth quarter, ma'am?
Actually, we have decided to keep on a received basis, cash received basis. Okay. Because the ISS has been getting delayed from the government side. We have not received ISS for more than one and a half years. So, factoring into the P&L was not looking fair to us, So then in this quarter, we decided to reverse the ISS provision which we had already taken for this year. And we have decided to go ahead with a policy of received basis only. Whatever we receive, we will factor in only that.
So we expect this to be received in this quarter or subsequent years only?
No, yeah. We are expecting some part to come in this quarter as well.
Okay. And one more question is with regard to the FII and DII investments. What I understand is other than in the public, other than promoters, public and others, no investments have come from FIIs or DIIs. Is there any reason for that, or it's linked to the corporate governance or?
Well, there is no reason for that. I don't know what to say and what to answer. No, there is no reason. There is nothing linked to the corporate governance or anything which is lacking from our side.
Because what I feel that if FIIs and DIIs come, the share prices may go up further.
Yes, you're right. That will happen and that should happen. I think last few years there was because of ethanol industry being a nascent industry, so there were a lot of policy changes which were constantly happening and which was impacting the profitability. So, but now I'm quite confident that as we give on quarter and quarter good results, we should see better movement and better interest in the market in our company.
So going by this 9 months numbers, I hope that for full year numbers, the EPS will cross 15 rupees or something like that. Is it reasonable to think over that line?
Yes, it is.
Thanks a lot and all the best, ma'am.
Thank you. Thank you.
Thank you. Next question is from the line of Viral Jain from Share India Securities. Please go ahead.
Ma'am, just wanted to your view again on the capex that we are likely to do, considering the fact that the situations have now changed after this maize prices. The geopolitical tensions have changed. So just wanted your view on the same.
So we are not looking at any fresh capex in the coming year or FY27. We are looking at giving out good results, improving the cash flows, and reducing the working capital. Any new capex will come in FY28, but in the meanwhile, we will take these next few 4 to 5 quarters to prepare and to plan for the next phase of growth for the company.
Considering the ongoing facilities, what is the optimum revenue that we can expect FY27 and FY28? Can we have a view on that?
In FY27, with the current capacities, we should be looking at a revenue of about 2,600 crores to 2,800 crores, based on the assumption of 85% capacity utilization.
Okay.
Yeah. And with the current infrastructure, we are capable of generating a revenue of 3,000 crores. So we are trying our best how to achieve that.
Okay. Thank you. Thanks a lot, ma'am.
Thank you. Next follow-up question is from line of Amit Agisha from HG Hawa & Company. Please go ahead.
Yeah, thank you for the follow-up. My question is about what is the tenure and visibility for the incentive, like 1.5 liter for MP and 2 liter for Assam?
For MP, we have received PLI for FY23-24 and FY24-25. Now, the PLI for FY25-26, which is the current year, is due, which will only be received in, say, second or third quarter of FY27. As far as PLI for Assam is concerned, there is a lot of paperwork which is required for that, and the pre-preparation to get the PLI is very, very high in Assam. So we are working on that, getting all the clearances. And as soon as that also comes, that should also start coming. But I'm expecting at least 6 months before we can start receiving PLI for Assam. In the meanwhile, we are expecting a central incentive from NEETS, which is about 5 crore, which we are expecting anytime should come to us for Assam.
Thank you. Thank you. Thank you. Thank you and all the best. Thank you.
Thank you very much. Ladies and gentlemen, we'll take that as the last question. I'll now hand the conference over to the management for closing comments.
Hi. Thanks, everyone, for joining this call. I thoroughly enjoyed taking the questions. All the questions were valuable, and I enjoyed answering them. And thanks to the organizers for putting this group together and putting this call together. I look forward to interacting more and more with our shareholders and the interested stakeholders. And we look forward to giving out good results quarter on quarter and maintaining these kind of levels in this quarter as well as the coming quarters. Thank you so much, and have a good day, everyone.
Thank you very much. On behalf of Gulshan Polyols Ltd, that concludes this conference. Thank you for joining us, and you may now disconnect the lines. Thank you.
Thank you.